what happened with the numbers we saw this week? Is the rest of the world's slowdown catching up with us?
I mean, certainly the manufacturing numbers are clearly weaker and exports are weaker. There's no question about that. I mean, the non-manufacturing parts of the economy probably are slowing down a bit as well. I mean, I think there's a question of degree.
I think that's the bigger issue because it's such a bigger part of the economy if you're looking at services. I mean, services came in with still some growth showing a number above 50, so that's growth, but a big drop down and below what had been the expected drop.
Yes. I mean, there is a certain amount of sentiment in those ISM numbers from month to month. And I mean, we had a 3.8 point drop yesterday after a 2.7 point jump the month before. But certainly the net of it has been weakening. And if you take the employment parts, which of course people are talking about a lot ahead of this morning, the employment parts of the two ISM surveys together, you put them together and they're consistent with close to a zero trend in employment. Yeah. So it's understandable from that perspective. There's a lot of anxiety going into this report. Conversely, though, you look at the claims number that came out yesterday, which arguably is more hard data, as just isn't really a sentiment in there. Right. I mean, it's not comprehensive. It's only one part of labor flows, but that's showing absolutely no sign of weakening. So it gives you both sides. And I mean, personally, I put a bit more weight on the claims numbers on a month-to-month basis. So I'm still looking for a reasonably solid 165,000 this morning, but with trepidation.
We go back to this idea of the good news is good news, the bad news is good news, the bad news. When's the bad news bad news?
Well,
meaning,
I mean, that's
what does the market really want to see?
I mean, that's the market question, not the economic question. But I would say ultimately the question is, are we going into recession or not? So it's one thing to say bad news is good news because the economy is a bit slower and it's going to get the Fed to ease. But if you reach the point where it means you're dropping into recession, then the Fed can't help the market, would be my view on that. And I don't think we're there, to be clear.
You don't think we're there. Lindsey, do you think we're there?
I think we're teetering on that point, that recession is certainly becoming an increasing concern. When we look at the non-manufacturing number that came in, it's tempting to say, well, it's still in positive territory. But with such a precipitous drop, we're now seeing pre-recessionary levels that we saw going into the 01 recession, the 07 crisis. And so we're very much looking at a sign from the service sector, the very large, important service sector of this economy, saying that the economy is very clearly slowing. Going into this week, we had seen evidence that weakness was bubbling underneath the surface. But now with the extreme weakness that we saw in manufacturing, confirmed now later by the non-manufacturing number, it's very clear that the domestic production sector is dissipating. We see the service sector stalling, and by extension now, the economy is slowing. And the concern is that it will continue to slow into recession.
To Jim's point, those ISM numbers are just surveys of how people are feeling about things, what they're seeing, what they're planning and expecting. Consumer confidence, same thing. Those are all kind of soft measures of what's happening. But what's the chicken and egg scenario in this situation? If the companies get concerned and start reining things in, could that then actually lead to the harder concerns and the bigger recession down the road?
Absolutely. When we look at the correlation between the ISM numbers and GDP, what we do see is that it's a very good predictor of where growth is headed. Now, it's not a perfect correlation, to your point. This is in good part soft data or sentiment, so really polling businesses on how they feel. But businesses, when they say this is how they're feeling, this is also what they're planning to do. And they're hesitant right now in terms of investing, in terms of hiring, and that will eventually trickle down and affect these numbers. And we do expect it to affect this morning's employment report. We're looking for a miss. Consensus is about 140 right now. We're looking for it to come under at 120,000. And I think the risk is to the downside. Certainly, this could be an even weaker number than what we're predicting.
So, Jim, when you said you're not there yet when it comes to recession, you're not in that frame of mind. When we do get there, because eventually that will happen, the Fed doesn't have the same tools that it used to have, right? So usually they cut by about 500 to 600 basis points. They don't have nearly that. Yeah. Are they going to use the balance sheet at this point?
Well, I mean, if it happens in the next year, which, again, I'm not anticipating, then absolutely they would have to do more than cut to zero. So they would, I mean, when Powell was asked about this at the last press briefing, and he was asked in the context of negative rates, he said, no, we'd use the funds rate, we'd go back to QE, and we'd use forward guidance. They're not anticipating using negative rates. But again, I mean, that's the question. Does it happen in the next year? Does it happen in the next 3 years? You're right. I mean, eventually there will be a recession again. But is it the next year? Is it 3 years' time? I mean, who's to say that you don't go through another bit of tightening before you get another recession? I mean, there clearly are risks of recession here. Absolutely. And these numbers are slowing. But, I mean, at this point, we're not seeing recession. But they are easing to ward off recession. You've asked Fed officials, would you prefer to see 3% inflation or recession in the next year, it's pretty easy. They'll go for the 3% inflation. So they're trying to avoid recession here.
Let me ask both of you very quickly. Steve made mention earlier about how the odds of a next rate cut coming sooner rather than later jumped yesterday. You think the Fed cuts at the next meeting?
I mean, we'll evaluate that after this morning's numbers, I would say. I mean, right now my call is the next move is December, but the ISM number was weaker than I expected yesterday, and we'll see what the apparel's number did this morning.
If the jobs number is weaker, you'll change your mind.
I mean, if it's weak enough, yes.
Lindsey, how about you? You think the Fed cuts next time around?
Absolutely. And even with a moderate number this morning, that doesn't change the directional momentum of the economy. The Fed is really being backed into a corner now. The data is pointing to a slowdown in the economy. And whether you want to call it an insurance-style cut or outright support for waning momentum, the Fed is going to have to step up and give us at least another 25 basis points in October and likely another 25 in December.